Hi, welcome to a quick video on notes receivable. Notes receivable are formal credit arrangements between a creditor, which is what we call the lender, and a debtor, also known as the borrower. The payment terms under the note are specified on the note, usually relatively long-term payment arrangements. Notes receivable arise from loans made to people and companies that need cash. In the case of companies, it's normally to finance growth. They also arise from sale of merchandise, other assets, or services, such as when you take a financing deal when you buy a car or a refrigerator at Best Buy. Notes receivable will be classified on the balance sheet as either current or non-current, depending on the expected collection dates. If the term is less than a year, it's reported as a short-term note. If the term is greater than a year, it is reported as a non-current note. Now, a little quick note, long-term note receivables will be studied in depth in the Investments in Securities chapter in Financial Accounting and Reporting 2, when we're looking at the non-current assets, the types of non-current assets on the balance sheet. Here, we're going to concentrate primarily on the short-term note receivable. So let's look at the short-term note receivable. Short-term note receivable, and this is, by the way, interest-bearing. An interest-bearing note receivable is exactly what it sounds like, a note receivable that bears interest, has a positive interest rate on it. It involves the collection of a specified face amount, but we'll note what is known as the principal, at a specified maturity date or dates. Interest on the note is received at a stated percentage of the face amount, specifically a stated annual percentage of the face amount. Interest is calculated as that face amount times the interest rate, which is the annual interest rate, multiplied times the fraction of the year that has expired by the time we are accruing it, or then it's due to be paid. So let's look at an illustration of a short-term interest-bearing note receivable. The Stevens Brace Company manufactures knee braces that it sells to athletic retailers. On May 1, 2024, the company sold braces to the developing pickleball outlet chain retailer. Stevens agreed to accept a $100,000 6-month 12% note in payment for the braces. And again, keep in mind that 12% refers to an annual percentage rate. The term is only 6 months here. Interest is receivable at maturity. And given the relative risk of lending to an early stage retailer, the 12% interest rate is deemed appropriate. The manufacturing cost of the braces sold to Pickleball Outlet was $65,000. Okay, and so the requirement here is prepare the journal entries that Stevens Brace Company will record associated with this note, given that Pickleball Outlet did indeed remit the full payment due on November 1, 2024. So you're going to have to account for the issuance of the note on May 1, the sale, of course, as well, in conjunction with the sale, the transfer of the inventory, and then account for the maturity date when both the principal and the interest are paid. And at this point, pause the video and work it, and then come back and see if I have the same answer. I think you'll get this one right. All right, good luck. Thank you. All right, welcome back. So here's what we got. We got, as always, I just headlined it, Stephen Brace Company, short-term notes receivable. That's the topic here. And here's the facts, along with the entry you know about. You certainly know about. So the key here is that we have a sale for $100,000, and then transfer of inventory that cost the company $65,000. So they made $35,000 on the sale. And the only thing new here is that to date, we've usually had either accounts receivable or cash. Where accounts receivable, if that's what's debited, it relates to a promise to pay within a very few days. So the company basically gave an interest-free, very, very short-term loan. Okay, so but this case, it's the note receivable. And here's the terms of the note receivable. The issue date is 1 May 24. Face value is $100,000. The stated interest rate is 12%. The effective interest rate is 12% as well. You're going to learn in a future course the difference between the stated and the effective interest rate. I will leave that for a future learning. The term is 6 months. And the maturity date is November 1 of this year. So 6-month life. May, June, July, August, September, October. And then at the end of October, we pay it back. 6 months. All right, so we have that. Now we just we have that receivable on the books, and it's going to earn at a 12% annual rate. So that's a nice little investment. If they pay, it's a nice little additional source of revenue for the company. And we also might have a great new partner to sell our goods to. So on November 1, 2024, indeed, the client, the customer, Pickleball Outlet, does send the $106,000 check. And that is for the note receivable principal, as well as the interest of $6,000. And if you had a different number, here's the calculation on that. Here's the interest component. 100,000 times 12% means that if this were a year long, it would have earned 12,000 of interest, but it's only 6 of the 12 months. So it's 6,000 of interest to go along with the 100,000 of principal. That's the 106,000. And that's the accounting for short-term notes receivable. Let's now take a quick look at what if this were what we call a non-interest bearing note receivable. So the topic here is short-term non-interest bearing notes receivable. A note that does not require the payment of interest is known as non-interest bearing because it has a 0% stated interest rate. Non-interest bearing is actually a misnomer. Nobody lets people use their money for 6 months free. Non-interest bearing notes do bear interest, but we must impute it. The interest is deducted from the face amount. Let's see an example. Stevens Brace Companies manufactures, again, knee braces. So this time all the facts are the same, except that the note is the $100,000 note is non-interest bearing. So prepare the journal entries. Okay. The big learning here is that we no longer sold these braces for $100,000. We sold them for $94,000. And here's the accounting for that. Sales revenue is $94,000, and then that $100,000 payment we're going to get in 6 months, that's $6,000 of interest and $100,000 of $94,000 of sales revenue. So our the difference between this case and the last case is our profit on the deal is only $29,000, And then once again, we did earn the $6,000. So rather than having a total of $41,000 of profit, the 35 plus the 6,000, we have that reduced amount. So the non-interest bearing note just meant we sold our goods a little bit less expensively. Right. And then when we get to November 1, we zero out that discount on note receivable because now it's interest revenue. It's not a discount anymore, which, by the way, was a plus asset account. Or I'm sorry, it's a contra asset when it was issued. I should have said that up here. Let's highlight that. It's a contra asset, and specifically contra note receivable. So keep that in mind. Now, we no longer have the contra asset because we've earned it. So we zero out the contra asset by debiting it, and we record interest revenue, and then we also record the receipt of the $100,000 on the note. So again, bottom line, in essence, we sold the braces for $94,000, not $100,000, and simultaneously made a 6-month loan. The $100,000 note is a sale of goods and the interest on the loan. Right. And that's non-interest bearing notes. So work those two cases, get that little subtle difference straight. And I'll just give you a preview now to long-term notes receivable. This is something, really, this is just for your preview. You'll study this in Financial Accounting Reporting 2, and you'll likely take that as a next course. The accounting for long-term notes receivables is the same as that for the short-term note receivables, except the time value of money has a larger, more significant impact. Hence, we account for the time value of money. So these same facts in this non-interest-bearing note would have looked like this. Oh, and by the way, we did double the amount of the loan to $200,000. So do note that. The sales revenue would be the present value of the $200,000 face value, which turns out to be $159,438.78, and then the discount is $40,561. We have the cost of goods sold again, and then we amortize the discount to interest revenue over the life of the loan, and then at the end we record the extinguishment of the note via the payment from our borrower. And so what's going on here is that because of the time value of money, the note on this non-interest bearing note is growing in amount. We add in the accrued interest, and it becomes a bigger note upon which 12% is earned. So again, just a preview here. You'll see this in your next course, and this will all be very, very common knowledge and a valuable skill ongoing. It's called the effective rate method. The effective rate of interest method. Effective rate of interest. All right, so you'll stay tuned for that in your next course. All right, thank you for your attention. Again, our primary focus here was the short-term note for now, since we're talking about the operating activities and the current assets of the business. So make sure you master the short-term notes receivable accounting. And then I just wanted to also preview when it is not a short-term note, but a long-term note. And then you'll learn that in the next class. Thank you for your attention and have a great day.